This shift from paper promises to physical assets isn't even just about gold.
We are entering a realm where physical availability, coupled with massive delivery demand in a paper market that is now being asked to settle real-world demand in real metal that the market may not actually have. The East is doing price discovery in physical, or the global South, and the West is still doing price discovery in paper. And the spread that we see, and growing spread between paper and physical prices, is what happens when those two worlds stop agreeing. We are seeing so much metal being delivered on COMEX. It's unlike anything we have ever seen before, ever. And it's not just gold, it's silver. The tight physical availability coupled with the massive delivery demand that is changing everything, because they're being asked to settle in actual metal. And that's something that never happened before, but it is breaking the system. That's why silver is going parabolic. And I would simply say this: all you need to know is ask yourself, who in the hell is doing this? Who stands for delivery for 100 million ounces of silver?
You've got to wake up. You've got to take the red pill. It's the value of your currency that's plummeting.
This is Little by Little with Andy Schectman.
Welcome back, everybody, to an episode of Little by Little with my good buddy Jason Cozens. As you all know, he is the CEO of Glint, a wonderful company that I have invested in and I utilize and I tell everybody about. It's an amazing technology. And Jason and I are going to talk today about something that is important to both of us, and questions on the logic of why 2026 changes everything. And in talking with Jason off screen, we talked a little bit about something that I think is really, really, really very important, as a matter of fact. And that is the fact that we are entering a realm where physical availability, coupled with massive delivery demand in a paper market that is now being asked to settle real-world demand in real metal that the market may not actually have, is coming to a crossroads, amongst other things, including mathematics. I'm a big math guy, and he says math might not be actually being straight with us. So I'm excited to dig into this with Jason, and Happy New Year, brother. Welcome back to the show, my good friend. How are you?
Happy New Year. I mean, it feels like it was already a lifetime ago, Christmas, but so much is happening at the moment.
We got New Year's party coming up in a few weeks already, you know.
Yeah. So look, I think that's right, is that this shift from paper promises to physical assets isn't even just about gold. You know, we're seeing chaos in, Tehran, and we're talking about borders shifting in the Arctic. And the question on our minds, I suppose, is this just normal geopolitical noise, or is this something we need to dive into deeper? And I think we do, because, as you say, on this concept that we're moving from this world of trading paper and the promises to secure physical assets. If you think about what's happened recently with silver, and you start applying that to the broader economy in a world where U.S. federal debt is now tripled since 2008. I mean, it's obscene. Interest rate levels would have triggered a recession at any previous cycle. So this chaos we're seeing on the news it seems actually to be a symptom of the same money problem that we saw in the silver markets, because the Venezuela and the Greenland issue is all about it's all about a mission to try and claim physical assets that is needed to get on with the growth of the economy, isn't it?
Well, it sure is, and it's two different things that we're talking about. One is that the East is doing price discovery in physical, or the global South, and the West is still doing price discovery in paper. And the spread that we see, and growing spread between paper and physical prices, is what happens when those two worlds stop agreeing. Now, when we talk about going around the southern hemisphere or into the Caribbean and into South America and moving up into Greenland, it starts to take on a different tone, if you will, a different tenor, where we are now going and seems to be having conflict with everyone, whether it be tariffs, whether it be issues with other countries militarily, whether it be bombing in Iran, bombing in Nigeria, bombing in Syria, threatening Greenland, threatening Mexico, threatening Cuba, doing what we did with Maduro. It just seems that this geopolitical rhetoric is ramping up, and there are consequences of that. In many ways, this is what is and has been, I think, part of the rallying cry of the BRICS. And you can hear Xi and Putin talking to their allies in the BRICS grouping and simply saying this is the problem. The West is the great destabilizing force. The United States and their Western allies are the destabilizing force. And, I listened, before we jump into this real quick, I listened to a very interesting interview with Gerald Celente the other day, Jason. And, he made some interesting points, right? And I'll frame it first by saying, look, we invaded Iraq 22 years ago under false pretenses. And we're still there, occupying their country. We destroyed it. We're occupying it. We put in a new regime. And yet we still feel it appropriate to continue to have a presence in their country. This is the kind of hypocrisy that bothers the world, where Gerald said, look, can you only imagine if Putin flew into Kiev and took Zelensky and his wife and brought them back? Oh my God, the uproar, the outrage. Or if he did something, if Xi did something similar in Taiwan, yet it's okay for us to do this. Now, granted, Maduro's a narco guy and possibly not or elected duly, but you could argue the same thing about Zelensky. He wasn't duly elected and he shut down elections. So what's good for the goose may not be for the gander. Now, I'm a patriot. I love this country and I would vote for President Trump again. I want that to be clear. But when you look and analyze this stuff, if you're not looking at it from the other perspective, why then you're really cheating yourself. It's like going to you're charged with murdering your wife, and you go to an attorney for your life, and the attorney says, "Listen, I don't need to know what the argument is of the defense or the plaintiff. Right? We're the plaintiff. We don't need to know what their argument is. We just need to know what your argument is, and that's all we need. You tell me your defense and forget about what they have to say. You're only looking at one side of the equation, and if it's something as important as the world reserve status, something as important as your investments or your future, you should know both sides. You should look at both sides equally and try and put yourself in that position, and that's how you succeed in debating, in business. Everyone wants to feel that they won. So in this case, when we're not looking at both sides, I think it's a mistake. So let's get into this. Let's talk about it. Tell me some of the things that your thesis entails as to why 2026 changes everything. What are you thinking, brother?
Well, let's start with the liquidity illusion, and there's a kind of belief that markets crash because everybody's selling their assets. They assume it's because investors are panicking and they're selling. But the question I've got in my head is that actually true?
Well, I can give you an example of how it's not true. Yeah. I can tell you that much. But go ahead, let me hear your thesis.
Crashes maybe happen because buyers disappear, causing those prices to gap down. And so we've seen all kinds of lessons. Like in 2020, we saw US Treasury market briefly stop functioning due to a lack of bids. It isn't necessarily that sentiment turns negative, but as I understand it, liquidity can disappear for all kinds of different reasons. I mean, one of them, what happens if it's this kind of black swan events? Something happens to a whole bunch of businesses or banks stop lending to each other, etc. And even though people want to be able to buy an asset or have confidence in it, there's no one else to buy those assets if they come to sell some of it for some reason.
Yeah, I mean, and I think we're seeing that right now in the repo market, where banks don't want to lend to one another, even overnight, partially because they don't trust the collateral, which has been an overabundance of mortgage-backed securities. They usually trade overnight as collateral in the repo market. When you repurchase, they usually trade pristine treasuries or mortgage-backed securities. And more mortgage-backed securities lately than treasuries, and the banks say, I don't want to trade with you even for 24 hours, and this presents a big liquidity issue. It's an issue of trust more than it is liquidity, because there is liquidity, but liquidity that doesn't want to be deployed, and so they would rather leave it with the Fed. And I can think of, 2008, when the price of gold was $1,000, it fell to $700. When the price of silver was 21 and it fell to 9. Now, in this environment, there was no selling retail, none. What it was it was controlled by leveraged futures contracts on the exchange. So sometimes you're right. At least it depends on how we clarify it. Who's doing the selling? Who's driving the price down? And is it being driven down through natural channels? In other words, is there an event where people are actually selling, or are we using synthetic levered futures contracts that are naked? In other words, nothing standing behind it but a bet and a deep pocketbook to drive the price down. But I do agree. I think liquidity is something that's going to be very, very important to follow going forward, because when you blow up an economy like a balloon, where spending represents the major catalyst for GDP, where consumer spending is the catalyst, and you stop seeing all of the air being blown into the balloon, just by its very nature, it starts to contract. And so you're right, it doesn't have to be mass selling. In this environment, it can just be stop spending, and that spending starts to create a contraction, or another way of saying that, stop the government intervention. And we stopped that for a while, and we saw the government sell their treasuries, right? The U.S. government was called quantitative tightening. Well, they stopped that. And now they're saying they're going to put air back into the balloon because it's starting to contract. How do they do that? By buying $40 billion a month of U.S. treasuries, which is another way of saying quantitative easing. So yes, we are heading into a world where it doesn't have to be, or we're already in a world, I would argue, where it doesn't have to be selling for the markets to contract. It's just the lack of air pumping into it through government intervention or a pullback by the consumer. Is that kind of what you're getting at?
Yeah, it is. Yeah, I think the third thing really is the to look at what I call fiscal dominance. For the first time in history, the US is spending more on interest payments than it is on its own military. You've talked about this a lot, but what does that actually do to the country's power? And we saw in 24 that interest rates expenses officially overtook defense spending. But the consequence, I think, is that this marks a transition from to fiscal dominance, where monetary policy exists primarily to fund debt. Now, if that happens, then how do they deal with all this active intervention? Where there's this kind of thirst to acquire physical assets. How are you going to fund that? Because this costs money. And the problem is, I see with fiscal dominance, is that constrained systems don't innovate. They have to ration. So I'm not sure what the answer is with any of these things, but I think these 10 questions I've got in my head are all things that we need to be asking ourselves. So what is it? What do you think about that?
Well, fiscal dominance is something that where you could argue this is part of the reason that you're seeing pressure put on the Federal Reserve to blur the lines really between the Federal Reserve and the Treasury Department. To your point, that the Federal Reserve is responsible for monetary policy and fiscal policy, the Treasury. And you're right, the Congressional Budget Office says by 2030 or 2031, 100% of tax revenue will go just to pay the interest on the debt. That doesn't take into account things like, they said it would go just to pay the interest on the debt and mandatory entitlements, which are off balance sheet, like Medicare and Medicaid and Social Security. But things like military, which is discretional, and they want to up their military spending here to over $1 trillion, will have to be borrowed. And so when you talk about the Federal Reserve losing independence, this is something that frightens the market, and largely, I would argue, because of fiscal dominance. So we talk, in fact, Goldman Sachs came out and said gold would go to the moon if the market believes that the Fed has lost independence. And I would say, well, what about Stephen Mirren, who is the architect of the Mar-a-Lago Accord, who was Trump's advisor, who now filled the vacated spot at the Federal Reserve? or the lawsuit that is being thrown at Fed Chairman Powell. In essence, what they are doing is putting pressure on the Federal Reserve to lower rates. That's what this is all about, and that is to, in my mind, to take care of this fiscal dominance problem, where we have a world where no one wants to buy our treasuries anymore, and who's going to do it? That's where the Federal Reserve comes in as the buyer of last resort. So the majority of the money and the policy is going to keep rates low, to buy our debt, because the world doesn't need it. It's a bad thing. It's a bad place to be. It really is a bad place to be, and it's something people should be very concerned about. And I think it leads to much higher levels of inflation, much greater levels of de-dollarization, of people selling treasuries in favor of things like gold, which can't be debased, which can't be deflated. And you're even seeing the deflated in value, that is, inflated overall. But you're even seeing the mainstream media come out and talk about the debasement trade. And in large part, that's what this is about, devaluing the dollar, because our fiscal irresponsibility has put us in a position where we have to put the majority of all the revenue that we take in just to cover and keep the lights on, to cover the interest, keep the lights on, and to continue to fulfill our promises, which are very, very ill-funded, or putting a great strain on the finances of this country. So yes, this is something people should pay attention to, and would have a profound effect on their investments. You would think it would be very bullish for gold.
Yeah, I mean, it's fascinating. I find all these contradicting forces that we've got in 26. So now we're talking about how scarcity returns. This move from infinite paper to finite reality. We're talking about, we've spent for decades, we've been trading all these paper assets that grow forever. But what happens when you hit the wall of finite resources like oil and gold? And we saw that in the silver market, as we've discussed. But this disconnect, the financial claim to growing faster than the real goods. Now scarcity is returning. We've seen, gold supply is only about 1 or 2% per year. Then, of course, you've got a situation like in Tehran. What happens if they respond by, and they've threatened they will do, closing the Straits of Hormuz, where 20% of global oil supply comes through there? Obviously, it harkens back to the action in Venezuela to secure other sources of oil for the US. But from a global economy perspective, a problem with 20% of global oil supply definitely affects all Americans. So the reality is you can print money, but you can't print oil, you can't print scarcity. Hence why we're moving towards gold and an ability to grab hold of oil and other assets. And we'll talk about in a minute why I think one of the AI, what AI is doing to the economy as well, and how that doubles down on this problem. But in a market that is leveraged, a supply shock can break the arithmetic of the entire global economy. So I think we've got so many areas where that supply shock could happen, haven't we?
Yeah, we do, and seems to be entering a world where paper promises are being usurped for real delivery of real metal. We are seeing so much metal being delivered on COMEX. It's unlike anything we have ever seen before, ever. And it's not just gold, it's silver. We're seeing huge demand for platinum. We're seeing huge demand for copper. And it's no coincidence that copper and silver and platinum have been put on the strategic mineral list. Now, the European Union did the same thing at the end of 23, and in November of this year, China said we are going to reevaluate our silver position and prioritize it for domestic needs. And then in retaliation to Trump putting silver on the critical mineral list, they said we're also going to massively limit exports. Now, they are responsible for 70% of the world's refining in silver. They are responsible for 90+% of the world's refining in rare earths, and the Eurasian continent is massively responsible for the majority of all rare earth mining. And so you get into a position where, for a long time, paper promises were the way that these commodities were valued and the way that they were traded. And now we're moving to, I think, into a position where those promises are being looked at as certainly inferior to the real thing. And I think you're right. You're going to see supply chains that start to buckle under national security interests. And these elements are worth far more than the currencies being used to purchase them. So I think you're dead on right with that, Jason.
And you've seen China effectively securing all of these assets for many years. I think they've been doing it longer than everybody has, and suddenly America's woken up to this. America is moving very hard to secure real assets. But of course, there are other countries. There's European countries. There's the UK. What happens when everybody starts waking up to the fact that they need to secure, strategic assets for their country and their economy? So it doesn't look good on that front either. And then, of course, we have this AI paradox, which is my fifth kind of thing I want to talk about, because, we all know that AI is supposed to be a miracle for productivity. But is it possible that it's actually going to make life more expensive for the average family, certainly in the next couple of decades? I see a big squeeze coming. AI lowers the value of human labor whilst raising the cost of human survival. So, I see it in our own business. I see it in businesses that we work with. AI is replacing tax-paying, white collar jobs. That shrinks the tax base, and so you've got all of these global AI data centers on track to consume as well as much electricity, I think, as Japan as early as this year. You've got a massive rush to secure processors and silicon, and of course, you've also got the threat of Xi wanting to invade Taiwan, and he's seen that Russia can invade Ukraine and nobody says anything, because who wants to get into a fight with a nuclear power? He presumably thinks the same thing. At some point, he's just waiting for his time to go into Taiwan. Of course, the administration understands this, and there's this massive rush to try and get production and manufacturing back on shore. And of course, I see this kind of devaluation of the dollar as something that's happening naturally, but it's actually been embraced by this administration, because they know that in order to export goods, if they've got to build a good manufacturing base, you've got to be able to also export it. Then they need a weaker dollar anyway. One of the curses of being the reserve currency of the world is that your currency is high, it's valuable, and that creates problems for exporters. And so I see all of this happening. I suppose my statement would be that you can tax a lawyer's income, but you can't tax a data center. This whole paradox of AI. I think the benefits are going to take a while to come through, and in the short term, we're going to have a massive problem hitting the tax receipts of all countries, including the US.
Yeah, you could argue that the artificial intelligence mania has fundamentally, or is fundamentally, breaking the cycle of employment. And you wonder if there's ever any turning back. You can't put the toothpaste back in the tube. You talk about a kid coming out of college, or a worker attempting to learn a new skill, and they're in a race against a technology that is improving exponentially. And by the time that they complete a training course or graduate, the Gen Z, that new job may also be on the verge of automation. This is the AI replacement cycle. I agree. And to your point, when millions of people are simultaneously cut off from the ability to provide for their basic needs, the social fabric doesn't just fray. You could argue it disintegrates. And that's a big deal, where you get, to your point, you get massive efficiency for the wealthy who own businesses at the expense of millions of jobs. This is the K-shaped economy. This is the Cantillon effect you always speak of, where the wealthy get wealthier and the poor get poorer, because the wealthy closest to the money supply buy assets that continue to move higher in this inflationary world we live in. And you speak before of Triffin's dilemma, which does say that as a reserve currency that you will always have a trade imbalance, because currencies, we can't provide the world enough currency through trade alone, so they need to sell their currency to buy ours in the open market, weakening theirs against ours, strengthening ours against theirs. And that is a problem. And I do believe that they are trying to address that through debasement of the currency outright. In fact, Vice President Vance has talked about this, as did the previous economic advisor, a true knucklehead, Jared Bernstein, from the previous administration, although he did write a report called Dethrone King Dollar that speaks to the fact that we can't be the reserve currency anymore because of what you just said, that the dollar is so strong that it eviscerates their manufacturing, because manufacturing flows to places like Vietnam or China where the currency is much less, costs much less. The owners get more, the board members get more, the shareholders get more. But in the end, our dollar goes, it goes less and less and less and less in terms of its purchasing power. And that is exactly what is happening. So I think you add into it AI, and then you add into it, Ray Dalio just came out and said publicly that 60% of the United States has a reading proficiency rate of below that of the 6th grade. So we're broke with massive indebtedness, we're uneducated, and we have AI coming into a world where we don't manufacture much of anything. And the same thing, you got in the UK a little bit differently, in terms of natural resources, where you have nothing. We all have our problems right now, whether it be natural resources, whether it be indebtedness and uneducated, and a world where AI is coming in to disrupt everything. And the jobs that AI and robotics will disrupt are not just blue collar or entry level. They will be white collar. Think if you are a radiologist looking at x-rays. Think if you are an accountant, as my son was before he came to work for me, a CPA at Price Waterhouse getting paid to analyze a balance sheet of a real estate investment trust. Why pay a kid 80 grand to do that when AI, just like that, it's done. These types of changes into the world are going to affect everything. And you'll see it even in terms of mining. You'll have robotics enter into the mining space where maybe the cost of mining goes down so we can go out and actually do these things and get the minerals that we need and go into places that are more dangerous, underwater or wherever it may be. The point of it is that AI is going to change the world, and that all comes back to natural resources. You need copious amounts of silver to make, to make AI a reality. You need all sorts of minerals in order to create robotics, in order to create weapons, in order to do all of these things that we need. It is all about energy. It is all about commodities that are a necessity, and it's also about what happens to the economy underneath it. And I would argue both of our countries, the United Kingdom and the United States, are in trouble. The UK came out recently and issued a report saying that we have, not only have we offshored most of our electric capability or our energy capabilities to other countries like France, but at the same time, we don't produce any of the things that we need in terms of rare earths, in terms of commodities, and we are at the behest of countries like China for so much of that stuff that it's hurting us. Well, the same thing is true here. And so the question is, how do we address that? What happens? And how can you be on the right side of that as an investor to make sure that, you're protecting your family first and foremost? So I agree with everything you've said so far.
Yeah, I mean, it's a scary world, and AI fueled Cantillon effect. I mean, that is not something that we want to wish upon the world, but it is already happening.
It is.
I mean, you mentioned there about energy, and of course, silver is used in solar energy. And the US now needs huge amounts of energy for this AI push. And for a lot of viewers, who listen to your podcast will know all about silver. You talk about it all the time, but of course, a lot of people don't realize that silver prices have gone vertical, and they won't. They'll be in it when they find out. They'll be wondering, is this just speculation, or did something physically break in the market? So, Andy, I mean, you're the expert on this as well. Why don't we talk about that? About silver prices surging, and the fact that this is again on the theme. One of the big themes in this podcast is about this scarcity versus paper world that we live in.
Yeah, well, and that's just it. I think, first of all, when you talk about silver, it's a tiny market relative to the capital that is and can flood into it. Excuse me. When that happens, I think the move can and will be fast and probably very much disorderly in a market that has rehypothecated. In other words, sold the same shares over and over and over again, because no one ever stood for delivery. That's changing, and it's the delivery mechanism. It's like Bernie Madoff, who ran a Ponzi scheme, the largest ever, and he ran a great deal. Everyone thought it was the greatest, making these big monthly checks, never touching the principal. It's when they said we need the principal that we have a problem. You look at the LBMA. According to David Jensen, they had, and that's the London Metals Association, the London Bullion Market Association, they have 2 billion ounces in outstanding spot contracts immediately deliverable against a 140 million ounce float. In other words, that float, those bars that are standing behind the contracts, in essence, are about 15 times outsized to the number of contracts. That's a problem. And that's what happens when you have a system that rehypothecates, or a paper system where no one ever stands for delivery. But I've been screaming for 4 years that the central banks are draining the exchanges. But in the last 15 months, it's been happening in the United States. Let me give you an example. To silver, in December, was the largest delivery for a month of December in the history of the COMEX market since 1974. The largest. 64,730,000 ounces of silver were delivered into the COMEX. It's called issued and stopped. Now, it doesn't mean it leaves COMEX. Some did. A good deal did. Doesn't mean that it's available either. That silver that was delivered into COMEX went into a non-deliverable category called eligible. And so far, just a half a dozen days or so into the new year, trading days, and we're already at somewhere very close to 35 million ounces of silver that has been delivered in a non-delivery month. So in the last 40 days, roughly 100 million ounces of silver has been delivered into COMEX. Now, that tells you the priority here. This isn't about paper promises, because less than 1% of contracts ever stood for delivery, ever. And now we're seeing massive amounts. And so when you talk about how this can change very quickly, yeah, I think you are witnessing a period of time where, paper promises are no longer demanded. And it is the tight physical availability coupled with the massive delivery demand that is changing everything, because they're being asked to settle in actual metal. And that's something that never happened before, but it is breaking the system. That's why silver is going parabolic. And I would simply say this: all you need to know is ask yourself, who in the hell is doing this? Who stands for delivery for 100 million ounces of silver, and why? And why have 8 Western banks held the largest concentrated short position in the 1,000 commodities traded on COMEX? Why is that breaking? Why supposedly have the U.S. banks gone long? Who's bringing all this metal in? And if a mint box of Silver Britannias or Silver Eagles, 500 ounces in each, weighs about 45 pounds, who's taking possession of 100 million ounces? What does that weigh? And where's it going? And the point of it is that it's happening, and you can see this real demand for real metal that is going to create some very big issues. And I think that is why silver is moving higher. You got people on the wrong side of this trade that are being forced really to look into the mirror at an existential threat, and either they cover or they potentially get wiped out. And I think that's not hyperbole either.
No, I mean, for those of you who don't know and have had your head in the sand, silver prices surged by 80% last year. And actually, Andy, one of the interesting things, because we saw similar squeeze on gold and the problems around physical delivery with gold. We were doing a lot of shipping of gold from London and other sources into the US during that tight period. Is that the COMEX has kilobars? It relies on kilobars, and so
So
for instance, it needs to be in a specific form. And so there was quite a big trade that a lot of people were doing, was taking their full market bars, those big James Bond bars, and having them refined and into a format that was accepted by COMEX. That's really never the kind of thing that normally goes on. So big problems there as that paper dam. Another example of that paper dam bursting. But the other thing is, I mean, the bond market, this is the seventh thing I wanted to talk about. The bond market is supposed to be one of the safest places in the world, certainly in finance. So, many people might be asking, why did it suffer a liquidity shock back in April? And I think you and I know the answers to that, but a lot of people don't, do they?
Well, no, I think that the bond market is really the root of all of this concern. And in an environment where we've suppressed interest rates for so long, assets like bonds have gotten completely and totally out of whack. Real price discovery is something that we haven't seen. In fact, I would argue the suppression of interest rates is what got us into all of these problems, pushing interest rates down, suppressing the bond market, pushing the yields higher, but creating distortions in asset prices, in stocks, in real estate, in bonds, in everything that is a function of the value of money. And when you mess with Mother Nature the way that we did by suppressing interest rates, the entire West did for a very long time, to create an illusion of wealth in your 401k, in your home price, when the bond market tries to find some symmetry or some real value between asset prices and the environment that would actually call for higher interest rates, things get very, very, very concerning. And the Fed understands that if rates rise, the amount of indebtedness and the distortions that were created through decades of suppressed interest rates in asset prices is something that has virtually no political backing. No political backing. No one is going to stand for that. If rates were to spike, not only would your home price collapse, but your stock portfolio would, banks would collapse because they're loaded with treasuries, insurance companies are loaded with treasuries. This is what happens. This is why the Fed is trapped. This is why they are going back to adding $40 billion a month in buying more treasuries. This is why they stopped offloading the treasuries they already have on their balance sheet, the quantitative tightening, because they're trapped. And going back to the balloon analogy, it's like there's a tiny little hole in the balloon, and if you continue to pump air into it, 40 billion a week, it may stay inflated. The minute you stop and the consumer starts to rein in and, heaven forbid, save and pay down debt, the whole thing collapses. This is the problem you get by messing with interest rates, and the bond market is a function of that. Now you add into it weaponization of the bond market, sanctions, and tariffs that are actually sanctions masquerading as tariffs. You start to get less and less and less global demand for the U.S. Treasury. Another big problem. So this all comes back. We're trapped. You're damned if you do, you're damned if you don't. If they defend the bond market, why then, everything else collapses. If they defend, let rates go to where they're supposed to, the whole thing collapses. So it's a very, very, very scary thing.
And I think people need to be really clear. In 2008, foreign ownership of U.S. debt was about 50%, and that's collapsed to less than 30%. There's a lack of buyers for U.S. debt because nobody wants that debt anymore. But that's what bonds are, by the way.
Which should mean that rates have to go higher because bonds get sold off, rates go higher, everything collapses, and that is. That is how it should be. So, but to defend the bond market, you have to suppress interest rates, which creates massive inflation. And that K-shaped economy we're talking about, and the Cantillon effect we're talking about, because if you save in dollars, your dollar goes less and less and less far to put basic necessities on the table. But, and that's
there's no political will for that.
Well, that's correct, and that is why the Cantillon effect is still in play, where the wealthy become exponentially more wealthy as their investments, their assets, go higher in an inflationary environment, but the dollar goes not as far. And a good way to show that is if you look at the price of a house in the United States 20 years ago versus today. The average price of a house 20 years ago was about $240,000. Today it's about $450,000. So your house nearly doubled. Sounds good. People would be happy, but so in dollar terms, your house went up, doubled.
Yeah.
But look at it in gold terms. Gold was $450 in 2005. Divide that into 250,000. You get about 500 ounces. So you could have used 500 ounces to pay off your house. You got 5 years left on your mortgage now. So you didn't. You stuffed it under your mattress, earning nothing but dust for 25 years, no interest. And here we are today with gold at 4,500 or 4,600. Those 500 ounces are worth $2.5 million. The average price of a house today, $450,000. It buys you 5 houses. So the point of it is that when you measure things in terms of assets, everything is decreasing in value. When you measure it in terms of dollars, everything is increasing. And that is why people get hoodwinked into thinking the dollar is safe because, well, it went up and it's great, it's great. But the dollar is what is depreciating, not the assets that we measure them in. Measure it in gold, and you'll see that to be true. Your dollar or your pound is like holding a melting ice cube.
Yeah, and this is effectively what we're talking about. Is the eighth thing I wanted to work about was the social cost, And, apart from housing doubling, you've got energy up 60%. You've got food prices up 40 or 50%. When money doesn't hold its value, long-term planning as well breaks down and time horizons shrink. So, inflation isn't just an economic issue, it's a social one. And I don't like the world that we're entering. But listen, I know we're running a little bit out of time. And let's just double down again for those people who are maybe not as educated in this. The fact that if the dollar is supposed to be king, then some might wonder why we have central banks spending the last 4 years buying record amounts of gold. Other central banks have decided they don't want to buy these dollars. I think the gold has become the second reserve currency of the world, i.e. they hold more gold than they do euros, for instance. And they're buying more gold than they are treasuries. So central banks have purchased more than 1,000 tons of gold for 4 consecutive years. This is the flip. Gold is now the main currency they're buying because gold is something where there's no trust required. Gold can't give you a tariff. Gold can't invade your country. Gold can't be printed. Gold is no one else's liability. It is the only real money. Everything else really is debt. So this is, again, a kind of movement towards settlement where you've actually got the real asset, it's yours already, and away from a world of complete counterparty risk.
100%. I couldn't say it better myself. Yeah, gold is an asset that is simultaneously no one else's liability. But
people are sleepwalking. They're absolutely sleepwalking. I mean, if I look out the window, people are 99% of the population don't listen to our podcast. They are sleepwalking and they are going to fall off a cliff. And that's what I worry about. And I suppose that comes to really, if people are still listening, the strategy for 2026. I don't think it's about winning. It's not about speculation. It's about not losing because this is a very fragile market. And the goal of 26 should be about making sure you don't lose it.
I agree. Look, and I say it again, simply, in the last 40 days on COMEX, we've seen almost 5 million ounces of gold delivered and over 100 million ounces of silver delivered in 40 days. Now ask yourself, the people at this level, 5 million ounces times $4,500, do the math. How many billions of dollars do you get? Or 100 million ounces of silver at $85, how many billions of dollars do you get? The thing of it is, as far as I'm concerned, Jason, is that you just need to ask yourself one question and understand this has been going on for 14, 15 straight months. At that level, the people who are doing this know where things are going. They do not do it just for the hell of it, period. And I think that what you are saying really is that if you save in currency, you're destined to go broke. And it's time to be a contrarian. It's time to think outside the box. It's time to look in gold and silver not as an investment or something that you hold only for chaos, but something that you hold to get out of the way of the debasement of the world's currencies, of the chaos that will ensue in the bond market should interest rates rise, especially where everything that is financial, stocks, bonds, real estate, are all inversely correlated to that moment. How does Glint play into all of this? What can people do to protect themselves with Glint right now instead of leaving their money in the bank?
Well, I think to summarize everything and to answer your question, Andy, if your savings depend on someone else staying solvent, and that could be a publicly listed business, or it could be, of course, a government-issued currency, then you're exposed. So how do you save in something which does not require anybody staying solvent? Well, of course, precious metals, gold and silver, are God's money. They don't change. Everyone talks to me about all the time as I go out and socialize. Oh, gold's going up a lot, isn't it? Silver's going up a lot. I'm like, no. Silver and gold are exactly the same as they were billions of years ago when they were created, when 2 neutron stars collided. You've got to wake up. You've got to take the red pill. It's the value of your currency that's plummeting. And of course, what Glint does and what we set out to do after I had the idea after the last 2008 financial crisis, is to give everybody, everywhere, the ability to buy gold and silver at very small amounts. There's democratize access to it, so you can buy gold and silver for as little as 1 cent's worth of gold. And this is real physical metal. This is not paper market we're talking about. You're buying allocated physical gold. It's in a vault that you own, backed 1-to-1, That's what you're buying. It's your gold. But then giving it something that normally people don't have, protecting their purchasing power, but giving them the ability to also spend it, because money is something you should be able to save and spend. So it protects you from all of the issues we've been talking about. You can put yourself onto your own personal gold standard, something that you can protect you from all of this systemic risk, protect you from inflation, but also spend it when you need to. You don't know when you might need to spend your savings. With Glint, you can spend it easily with the Glint debit card. And increasingly in different countries, you can also peer-to-peer. Just send it to one person, another person who's got a Glint account outside of the banking system, outside of that risk, just from one app to another.
How soon before we get that in the United States, the ability to send money back and forth? And there's no cost in that, too. How long before?
Yeah, well, we're looking to have that up and running for the second half of this year. So we're getting ready for, of course, we've talked about it in other podcasts, we're getting ready for the implementation, execution for all of this US gold, state authorized gold and silver currency. And we're looking to have that all in place for June.
Wonderful, wonderful. What last things do you want to, what haven't we talked about? What last piece of wisdom would you like to impart upon the audience, and something that you think is big for 2026, maybe the most important thing to keep your eye on?
I think you've just got to wake up to the fact that the rules of money are changing, and that clarity is your advantage. I think you've got to become educated. You've got to be awake, and you've got to realize that when the black swans start happening, you won't have time to reposition. So you need to get ahead of that. And I'd say, Glint offers you the opportunity, Andy, to be able to get ahead of that. You can buy as little as 1 cent or 1 pence worth of gold or silver. There's no excuse for anybody not to be able to get positioned in this. Of course, we have people with millions or hundreds of millions of dollars on our platform, but everybody should be able to do this. And I'd say get educated, use AI, lean into it, get the productivity that it promises. Don't just leave it all to the richest people in society, lean into it, but then see how powerful it is and how frightening that is as well to society. Watch the news, see actually what is happening here. This is pretty serious stuff.
It is for sure, and that's why I am an investor in Glint. That's why I use it myself. That's why I talk to people about it and recommend it through our company, which, if it wasn't something that I thought was very legitimate, something that had great utility, and didn't trust the people standing behind it like yourself, I wouldn't do so. Jason, as always, it's wonderful to see you. I know we're going to try and do this a couple times per month, and we really ought to. Just to have a conversation back and forth. I think it's very, very helpful for a lot of people who have questions that they maybe aren't asking, and maybe they didn't even know to ask. But this back and forth type of conversation, which is how I like it rather than scripted questions, is fantastic. So I want to, again, thank you, wish you and your family a very happy, healthy New Year. And I know I'll see you in person soon, but I'll see you back here. In a couple of weeks, and I look forward to picking up where we left off.
And to you, Andy, same sentiment. Thank you very much.
You bet. Take care, my man.
Thanks.
This is Little by Little with Andy Schectman.